Hello, I'm Richard Hunter, Head of Markets, and welcome to our look ahead for the week commencing the 21st of July. Despite all the tariff turmoils we've been seeing this year, it's actually something which markets have been able to shake off of late, helped more latterly by the extension to the deadlines which the President announced. In the US, it's also been helped by a very strong start to the earnings season, the second quarter half-year earnings season, and also some encouraging noises coming out of a retail sales figure. In the UK, of course, it remains very much the case that the Premier Index is in vogue as an investment destination amongst all this turmoil. What that's led to is that in the year to date, the Dow Jones is currently up by 4.6%. Both the S&P and NASDAQ closed at record closing highs on Thursday. S&P up 7%, NASDAQ up 8.2%. And the FTSE 100, of course, has been testing its own record highs of late, currently up by 10% in the year to date. Turning to next week, busy couple of weeks coming up now in terms of the corporate calendar. UK banks, and particularly UK focused banks, are kicking us off. We're talking about Lloyds and NatWest. We'll be looking out for the normal kind of things that are important in terms of key metrics, net interest income, impairments and any bad debt situations. And of course, if we're seeing any initial tariff impacts in any of their operation. For Lloyds, shares are up about 33% over the last year. Yield is currently 4.1%, and obviously shareholder returns may yet become a focus of this half-year reporting season. For Lloyds specifically, there is the overhang of the motor finance commission arrangements. The bank has already put aside £1.2 billion in potential impairments. We'll see if there's any updates there. It's also a very large mortgage lender, so that will obviously be important in terms of loan growth, and traditionally a very good bank in terms of cost income ratio. That's another thing to look out for. Moving on to NatWest, shares up by about 51% over the last year. Similar yield, 4.3% in terms of the dividend. A couple of things to look out for. Obviously, the government stake has now been entirely removed. There are questions whether, as a result, NatWest might become more acquisitive. It's already bought the Metro mortgage book as well as Sainsbury's Bank, and apparently had a bid rebuffed for the UK operations of Santander. So let's see if anything else comes along there. Quite apart from that, of course, buybacks and dividends, we are aware that the likes of NatWest, much leaner animal than it used to be. We could be seeing more shareholder returns. There's also a first quarter update from BT, shares up by about 40% over the last year. This is a company in the midst of a turnaround plan, so we'll be looking out for further evidence of cost savings and general efficiencies. There is something of a cloud over the business division, and that's quite a big slug of its revenues. That's something to watch out for. More positively, the Openreach division has been firing on all cylinders. Let's see if that momentum has continued. And there's also some hopes which has been propelling the share price, that in terms of the transformation, the peak of capital expenditure has been passed. Quite apart from those stocks, also look out for updates from the likes of Vodafone, Reckitt and ITV. Thank you for watching. Have a great week.